In this question, we'll practice the concept of expected utility. Let's start with a very simple example. We have the following investor with utility function square root of x. And this investor is offered the following two choices. Receive $1,000 with probability 1, or participate in the following lottery, lottery A, which with probability 1/2 pays $1,100, and with the remaining probability 1/2 pays $900. So the question is, this investor with this utility function, which of the following two choices she prefers? What I have done here is I've written expected utility of this investor for this lottery and for this sure payoff. Let's start with the lottery. The expected utility of this investor equals to 1/2 the utility of the payment in the first outcome, which is $1,100, plus another half times utility of $900. This is the second outcome. So these are the utility from these payoffs, weighted by the probability of these two outcomes. So our utility function is just a square root function. So this first part becomes 1/2 multiplied by square root of 1,100. The second part becomes 1/2 multiplied by the square root of $900. So if I compute this, I get 31.58. Now, in this first choice, which is the sure payoff of $1,000, the expected utility is just utility of this $1,000 because this is a certain outcome, which equals to, again, given our utility function, this equals to the square root of $1,000, and this equals to 31.62. Now, which of the two this investor picks? Well, let's figure out which of the two options gives us higher expected utility. The expected utility of the first option is 31.62. The expected utility of the second option is 31.58. Since 31.62 is greater than 31.58, this investor should go for this first choice, which is the certain outcome. Now, the reason for this choice here is that we're dealing with a risk-averse investor. If we compare the expected payoff of the first option and the second option, they're the same. The expected payoff of the first option is just trivially $1,000. The expected payoff of the second option is also $1,000. It's 1/2 times the first payoff, $1,100, plus the other half times $900. This is the second. This is the payoff in the second state of the world. So the average of the two is just $1,000. So the expected payoff of the first option is exactly the same as the expected payoff of the second option, but there is more uncertainty of the second option. And since we're dealing with the risk-averse investor who has a concave utility function, this investor goes for a certain outcome with exactly the same expected payoff as less certain outcome with the same expected payoff. Now, in the second part of the question, we have the same investor with the same utility function, but now she has a choice between the following two lotteries. Lottery A is the same exact lottery we had in the first part of this question, and lottery B. So lottery A with probability 1/2 pays $1,100, and with probability 1/2 pays $900. Now lottery B with probability 1/2 pays $1,250, and with probability 1/2 pays $750. Now the question is, which of these two lotteries this investor will choose? Now let's compute the expected utility that this investor will get from lottery A and lottery B. We've already done this calculation for lottery A, so the expected utility equals to 1/2 the utility of $1,100 plus the other half utility of $900. This gave us 31.58. Now let's do the same calculation for lottery B. So the expected utility equals to 1/2 utility of $1,250 plus the other half utility of $750. So the utility function again is the square root function. So it's 1/2 square root of $1,250 plus 1/2 square root of $750. That gives us 31.37. So given these two expected utilities, which of the two lotteries our investor prefers? Well, since lottery A gives her a higher expected utility compared to lottery B, then this investor is going to prefer lottery A to lottery B. The reason for this choice is exactly the same reason as we had in the previous part of this question. Both of these lotteries, A and B, offer the same exact expected payoff. So it's $1,000 in both cases. You could see the symmetry of these outcomes. However, there is more uncertainty and more risk in the lottery B because the outcome is more dispersed. So it's 1250 or 750, while the first one is either 1100 or 900. And just because this investor is, again, risk averse and his utility function is concave, this investor would prefer to take less risky lottery that offers the same expected payoff. And so therefore, she chooses lottery A in this particular case. We have learned in this question how to work with expected utilities. To summarize, for any risk-averse investor, anyone with concave utility function, if there is a choice between lotteries that offer the same expected payoff, a risk-averse investor will always prefer the less risky lottery.
In this question, we will learn how to find certainty equivalent for an investor with a given utility function and for a given lottery or for a given investment opportunity. You are given the following lottery. With probability 0.1, the payoff is $80,000. With probability 0.3, the payoff is $20,000. And with probability 0.6, the payoff is $5,000. If the investor has utility function u of x equal to x, what is the riskless payoff that would make her indifferent between choosing this particular lottery and the riskless payoff? Then part B of this question gives you an investor with a different utility function, which is u of x equals to x raised to the power 1 over 2, and asks you the same question. And part C of this question gives you yet another investor with utility function u of x equals to x raised to the power 1 over 3. In this question, we ask to find what in economics we refer to as a certainty equivalent. Let me define what it is. Certainty equivalent is the smallest riskless payoff amount that makes an investor indifferent between taking a risky lottery or accepting this certain amount. Mathematically, our utility from certainty equivalent or from this guaranteed riskless payoff should equal to the expected utility that we'll get from engaging into this risky lottery or risky investment. To find certainty equivalent for an investor with a given utility function and a given lottery, we need to do the following two steps. Step number 1, find expected utility of investor from this given lottery. And step 2, find certainty equivalent by inverting the utility function. Let's find certainty equivalent for investor in part A, investor with a linear utility function. So step 1 is to find expected utility that this investor will get from this lottery. We have already learned how to do this in question number 1 of this recitation. So the expected utility of this investor equals to 0.1 times the utility of the first payoff, which was $80,000, plus the probability of the second state times the utility that we get of the payoff in the second state, that's $20,000, plus the third probability or the probability of the third state multiplied by the utility of the payoff that we get in this third state. Since the utility function is linear, this just becomes 0.1 multiplied by 80,000 plus 0.3 multiplied by 20,000 plus 0.6 multiplied by 5,000. Computing this gives us the expected utility of 17,000. So this is the expected utility of this investor from this given lottery. Now in step 2, we can find certainty equivalent. The utility of this certainty equivalent would equal to $17,000. In the case of this investor, she has a linear utility function, so u of CE, which is equal to CE. And so therefore, certainty equivalent for this investor is just 17,000. So therefore, this investor is indifferent between just taking guaranteed $17,000, this is our certainty equivalent, or playing this lottery. Let's find certainty equivalent for the second investor. Recall that her utility function is square root of x, or x raised to the power 1 over 2. Let's do the same two steps as we have done in part A of this question. So step 1, we'll find expected utility of this lottery for this investor. We're starting with exactly the same equation. The only difference right now is that utility function is different. So therefore, where we had 80,000 before, is going to be 80,000 raised to the power 1 over 2. So the full expression looks like this. 0.1 multiplied by 80,000 raised to the power 1 over 2 plus 0.3 multiplied by 20,000 raised to the power 1 over 2 plus 0.6 multiplied by 5,000 raised to the power 1 over 2. So computing this gives us expected utility that this investor will get from this lottery of 113.14. Now in the second step, we can find certainty equivalent. So U of CE equals to 113.14. Now for this investor, U of CE equals to CE raised to the power 1 over 2. And so now we have to solve the following equation. So CE raised to the power 1 over 2 equals to 113.14. This is a simple equation to solve, so this gives us CE equals to 113.14 raised to the power 2. Computing this gives us 12,800. So therefore, this investor is indifferent between taking $12,800 and playing this lottery. So in other words, her certainty equivalent, or the riskless amount that she's willing to trade instead of playing this lottery, is $12,800. Finally, let's find certainty equivalent for the third investor. Recall that this investor has utility function x raised to the power 1 over 3. We will do exactly the same two steps as we have done in part A and part B of this question. So step 1, we're starting with the same equation. The only difference right now will be that the utility function is different, and so therefore $80,000 will have to be raised to the power 1 over 3, so $20,000 will have to be raised to the same power, 1 over 3, and $5,000 will have to be raised to the power 1 over 3. Computing this gives us expected utility for this investor of 22.71. And now in step 2, we can find certainty equivalent. So we need to solve this equation. So U of CE equals to 22.71. U of CE equals to CE raised to the power 1 over 3, because this is just our utility function. That equals to 22.71. So therefore, CE equals to 22.71 raised to the power 3. And this equals to 11,715.61. So therefore, this investor is indifferent between taking $11,715.61 and playing this lottery. Let's conclude and summarize what we learned so far. We're given three investors. Investor A is risk neutral because she has a linear utility function. Both investors B and C are risk averse because they have concave utility function. Investor C is more risk averse than investor B. So therefore, if all three investors are presented with the same lottery, we would expect that certainty equivalent of investor A would be higher than that of investor B, which in turn will be higher than that of investor C. And this is exactly what we found. Investor A is willing to trade the lottery for a guaranteed payoff or certainty equivalent of $17,000. Investor B is willing to trade off the same lottery for $12,800. So the difference between certainty equivalent of investor A and investor B shows you how much more risk averse investor B is compared to investor A. And certainty equivalent of investor B is greater than certainty equivalent of investor C, which is $11,716, which again is due to the fact that investor C is more risk averse than investor B and is willing to trade this lottery for a lower guaranteed amount. Let's consider another lottery. This lottery is similar to the original one in the sense that it has the same expected payoff, and you can verify that, but it is more risky. So the standard deviation of the payoff of this lottery is higher. You could see that the first payoff, I increased it from 80 to 89,000, and I decreased the bottom one from 5,000 to 3,500. So this is what makes this lottery more risky. What I want to understand here is how do certainty equivalents change for investor A, the one with the linear utility function, and for investor C, this was the one who was the most risk averse here. Let's start with investor A. So first we compute expected utility that this investor gets from this lottery. So this would be 17,000. This is by construction. I constructed this lottery to be as such. Now, if we want to find certainty equivalent for this investor, recall that this investor has linear utility function, so the certainty equivalent of this investor is just $17,000. So therefore, this investor is indifferent between taking $17,000 and this lottery. And therefore, this investor has exactly the same certainty equivalent as with the previous lottery, although this lottery is riskier. This happens because this investor is risk neutral. She doesn't care for the fact that this lottery is riskier. And this is illustrated by the fact that certainty equivalent for this investor is the same. Now, let's consider the next investor, the one who was risk averse. The expected utility from this lottery for this investor is given by this equation. If we compute this, this would give us 21.72. Now, if you find certainty equivalent, so certainty equivalent is going to be equal to 21.72 raised to the power 3, and so this would equal to $10,243.43. So for this investor, certainty equivalent decreases. And this is expected because this investor is risk averse. In this case, she's presented with a lottery that has exactly the same expected payoff, but it is a risky lottery. And because this investor is risk averse, it stands to reason that the certainty equivalent or the guaranteed amount that this investor will be willing to trade for this lottery decreases. And this is what we see by doing these calculations. In this question, we will learn how to find risk premium for an investor for whom we know their utility function and for a given investment opportunity or for a given lottery. We will consider the following two investors, A and B, with the following utility functions. You can verify that these utility functions are concave and both of these investors are risk averse. There is an investment opportunity that with probability 0.5 returns 25% return, positive 25%, and with the remaining probability 0.5 returns negative 25%. We will start by assuming that both of these investors have initial wealth of $1. And first we'll compute the coefficients of relative risk aversion, evaluate it at their initial wealth. And 2, for both of these investors, we will compute risk premium associated with the above investment opportunity. Let's start by computing the coefficient of relative risk aversion for both of these investors. By definition, relative risk aversion of a given investor with wealth W is given by the following expression. So it's negative wealth multiplied by the second derivative of the utility function evaluated at W divided by the first derivative of the utility function evaluated at W. Let's start with the first investor. Her utility function is this. It's x raised to the power 1 over 3. And what we need to do, we need to compute the first and the second derivative of this utility function so that we can compute the coefficient of relative risk aversion. So the first derivative of this utility function is given by the first part of this expression, and then the second derivative we can compute is given by the second part. Plugging both of these expressions into the definition of relative risk aversion gives us the following, which, if we compute, just gives us 2/3. So therefore, the coefficient of relative risk aversion of investor A is just 2/3. Now, let's do the same for investor B. This is investor B utility function. And so the first step is again to compute the first and second derivative of this utility function. And these are the expressions for the first and the second derivative. Plugging both of these into the definition gives us the following expression. If we compute this, we get 1/3 multiplied by W. And since the question asks us to evaluate the coefficient of relative risk aversion for both of these investors at the point of their initial wealth, we need to plug in W into this equation for investor B. So given that her wealth is $1, this gives us the coefficient of relative risk aversion for this investor of just 1/3. So to summarize so far, investor A has a higher relative risk aversion coefficient, and it equals to 2/3, and investor B has a lower relative risk aversion coefficient, and it equals to 1/3. Both of which are evaluated at their initial wealth of $1. Let's find the risk premium for these investors. By definition, the risk premium pi is the fraction of wealth that an investor is willing to lose that makes her indifferent between a risky, zero expected return investment X and the sure loss pi. Mathematically, we can write it as follows. Recall that the investment opportunity that we have in this question is as follows. So it's either positive 25% or negative 25% with equal probabilities 1/2. So notice that this investment opportunity is zero expected return investment. Let's first compute the expected utility from investing into this project or investment opportunity. So by definition, it's 1/2 times utility in the up state. So this is $1 multiplied by positive 25% return, plus another half multiplied by the utility of $1 multiplied by 1 minus 25%. So this is our loss state. Given that the first investor has cube root utility function, for her, this expected utility becomes as such. 1/2 multiplied by 1.25 raised to the power 1 over 3 plus 1/2 multiplied by 0.75 raised to the same power 1 over 3. And so this gives us 0.993. Now, knowing this expected utility, we can compute the risk premium for this investor from this equation. So again, the utility function is cube root, and the wealth of this investor, W, is $1. So this gives us this equation. 0.993 equals to 1 minus pi, raised to the power 1 over 3. All we need to do is to solve this equation for pi. And this gives us 2.12%. So therefore, the risk premium required by this investor for this investment opportunity is 2.12%. In other words, this investor is indifferent between losing for sure 2.12% of her initial wealth of $1 and engaging in this 0% expected return investment opportunity that has certain level of risk. Now let's compute risk premium for investor B. We start with the same exact equation. The only difference right now is, of course, the utility function. So for this investor, the expected utility from this investment opportunity is 1/2 multiplied by 1 minus e raised to the power negative 1.25 divided by 3 plus 1/2 multiplied by 1 minus e raised to the power negative 0.75 divided by 3. So this equals to 0.281. Now again, knowing this expected utility, we can find the risk premium for this investor. Again, we know the utility function and the initial wealth is $1. So therefore, this gives us the following expression. All we need to do is to solve this expression for pi. Doing this gives us 1.04%. So therefore, this is the risk premium required by this investor for this given lottery. So in other words, this investor is willing to lose for sure 1.04% of the initial wealth $1, indifferent between that and engaging in this 0% expected return, a risky investment opportunity. Let's summarize. When both investors A and B have initial wealth of $1, investor A has a higher coefficient of relative risk aversion compared to investor B. Risk premium required by investor A to invest into this lottery is also higher compared to that of investor B. So therefore, both relative risk aversion coefficient and risk premium line up in such a way that if the coefficient of relative risk aversion for one investor is higher than that for another one, the risk premium required for investing into this given investment opportunity would also be higher for the investor with the higher coefficient of relative risk aversion. Let's now assume that both of these investors got richer. Their wealth was $1. Right now their wealth is $5. We will repeat the same calculations. So we'll compute the coefficients of relative risk aversion for both of these investors given their new wealth. And we will compute the risk premium associated with this risky investment opportunity that we are considering in this question. Recall that the relative risk aversion that we computed for investor A was just 2/3. Notice something very important. This coefficient of relative risk aversion for this investor does not depend on her wealth. It's 2/3 regardless of how rich this investor is. This is what we call constant relative risk aversion. The risk aversion of this investor does not depend on how wealthy she is. For investor B, however, the relative risk aversion does depend on the wealth of this investor. Recall this, that the relative risk aversion of this investor was 1/3 multiplied by wealth W. So when wealth is $5, the relative risk aversion of this investor is 5/3. So generally for this investor, risk aversion increases as this investor gets richer. Now let's compute risk premium for investor A. First, we're computing the expected utility this investor gets from this lottery. It's the same expression as we had before, but right now instead of $1, we have $5. This is our current wealth. Computing this gives us the expected utility of 1.698. And now we can compute the risk premium by solving the following equation. So recall that the utility function of this investor is cube root. And the wealth right now is $5. Solving this equation for pi gives us 2.12%. This is exactly the same 2.12% as we had before. So now, given a higher wealth of this investor, so $5, this investor has still required risk premium of 2.12%. And in fact, this risk premium would not depend on the level of wealth of this investor, just because the risk aversion of this investor does not depend on her wealth. Now for investor B, we have the same expression. Using the utility function of this investor, we can compute that the expected utility from this lottery is 0.794. To compute the risk premium, we are solving this equation. We know the utility function, we know W, which is $5. Plugging this in gives us this equation, which we need to solve for pi. Solving this equation for pi gives us 5.06%. And so, given the wealth of $5, this investor right now has a risk premium of 5.06%. Let's summarize. Investor A has a constant relative risk aversion. Regardless of whether her wealth is $1 or $5, the coefficient of relative risk aversion of this investor is just 2/3. Regardless of how rich this investor is, the risk premium associated with this particular investment opportunity is 2.12%. For any other level of wealth, it will always stay constant at the same exact level. Risk premium, of course, would differ if we give this investor a different investment opportunity. That investment opportunity may have a different risk premium. But for this particular investment, for any level of wealth, risk premium stays constant. But investor B, the richer this investor becomes, the more risk averse she gets, is indicated by increasing relative risk aversion coefficient. When her wealth is $5, the coefficient of relative risk aversion is 5/3, which is higher than that of investor A at that level of risk. And so therefore, when you compare risk premium for investor A and B, when they both have wealth of $5, the risk premium required by investor B is higher than that of investor A. Finally, as investor B becomes richer, her relative risk aversion increases, and so does the risk premium she requires from investing into this lottery. You could compare the first case when her wealth is $1 and her risk premium is 1.04% to the case when her wealth is $5 and the risk premium is 5.06%. This risk premium will continue rising as this investor gets richer. In this question, we will work with historical returns and we will learn how to compute major statistics, means, standard deviations, and correlations. We will work with the following three exchange-traded funds: Vanguard Total Stock Market ETF, iShares 20+ Year Treasury Bond ETF, and Vanguard FTSE Emerging Markets ETF. Our sample will consist of monthly returns and will cover the last decade, January 2010 through December 2019. Before we go ahead and compute statistics, let me first tell you a few interesting facts about these exchange-traded funds. This is an example of a fact sheet for Vanguard Total Stock Market ETF. It shows few interesting statistics. First, it shows the number of stocks currently traded on the US exchanges. This number is 3,535 stocks. An interesting fact is that the number of publicly traded firms in the United States has been declining over the past decade. Second, we can see sector breakdown of the US economy. Technology comprises a quarter of all publicly traded stocks in the US. Financials in the second place, healthcare in the third. And finally, here we can see the largest stocks in the United States. As of March 31st, 2020, Microsoft was first, Apple second, Amazon, Alphabet, and Facebook are the third, fourth, and fifth. Second ETF is a 20-plus year Treasury bond ETF. This ETF invests in long Treasury bonds. You could see that all of the top holdings consist of Treasury bond. These are the bonds that at the time of issuance have 30 years until maturity. If you look at the current portfolio of holdings as of July 9, 2020, these are the different maturities on these long bonds that comprise the portfolio of this ETF. And indeed, you could see that all of them have more than 20 years to maturity. Finally, the last ETF is the Emerging Markets ETF. Here, some of the interesting statistics come from composition of countries in this ETF. So you could see that China has almost 50% of the entire holdings of this ETF, followed by Taiwan, India, Brazil, South Africa, Russia, and so forth. You could see that sectoral breakdown in emerging markets is a little different compared to the United States. The first sector that has more than a quarter of all holdings is financials, followed by technology, consumer services, industrials, and consumer goods. Now that we have some color on these ETFs, let's start working with data and compute basic statistics. This is the data file that gives us monthly returns. So it starts from January 2010 and goes all the way to December 2019. The numbers in this file are percentage returns. For example, in January 2010, VTI had a negative 3.5% return. And so all of these numbers that are given here are just percentages. Let's start with sample mean. Here I provide formulas so that we can easily see what is it that we're trying to compute. I will try to use directly the formulas and compute by hand these statistics, and then I will show you shortcuts and some of the formulas in Excel that allow to compute some of these basic statistics, but more easily. So let's start with the sample mean. Sample mean by definition is just the sum of all returns divided by the number of these returns. So I'll first compute it by hand. So I will say sample mean here. And I will first add up all of the returns, for example, for VTI. So this is the sum of all the returns. And then I will divide it by the number of observations that we have here. So the number of observations we have 10 years and monthly return. So it's 120. So if I divide this by 120, this would be the mean return that we had on VTI during this sample period. Now, another way to compute sample mean is just to use average function in Excel. So if we do this, we get exactly the same answer. So we could see that the return is exactly the same. So from now on, I will just use the average function to compute the returns. So I'll say average here, and I will extend this to the other two ETFs. So here we can see the following. the average monthly return on the US entire stock market on this ETF is 1.12% per month during this time period. The long bond, the TLT ETF, the average return was 0.65%, which is perhaps higher than you would have thought because this is a fixed income instrument issued by the government. And finally, emerging markets produced 0.4% monthly return, which is during this sample period significantly below the monthly return that was produced by the US stock market. Next, let's compute sample variance. I will create some workspace for me here. And the first thing that I would like to do is I would like to use directly the formula to compute the sample variance. So I will take the differences between monthly returns and the estimated sample mean. I will square them, I will add them up, and then I will divide it by t minus 1. So I will do it here. So I'll take the difference between a return in a given month minus the estimated sample mean. And I will square this difference. Now I will add up and sum up all of these squared differences. And then I will divide this number by t minus 1. So t in our case is 120, minus 1 is 119. We are, by the way, dividing it by t minus 1 because we are already used this data to estimate sample mean. So we are losing 1 degree of freedom when we're estimating the second moment or the variance here. And so this number right now, so 13.873, this is sample variance. For us to get sample standard deviation, I'm just taking the square root of this variance. And this is the number right now. Now, there is, of course, much easier way in Excel to do the same calculation. So all I have to do is that I can use stdev.s function. So this is the function that computes sample standard deviation. So if I do this and I just simply take all the array of returns, I hit enter, I get exactly the same number. So the standard deviation of returns on VTI is 3.725%. And so now I'll just delete this here. I showed you how to compute this. Now we can just directly use this function for the rest of the ETFs. So I will say this is sample standard deviation. And since we computed this for VTI, we can extend this and to compute it for the other two ETFs. So very interestingly, you could see that the sample standard deviation for the long bond ETF is almost the same as for the stock market in the United States. So the returns on long bond are quite volatile. And again, you can also see that the standard deviation on the returns on the emerging market is actually quite a bit higher than the standard deviation of returns in the United States. Now finally, let's compute covariance. I'll first compute, again, covariance by hand and then correlation by using the formulas here. And I will do it for VTI and TLT. So first I'll compute the differences between monthly returns and estimated means on the two ETFs. I'll multiply them and then I will add them up. So I will create just a little bit more, again, workspace for me here. So the first thing I will compute is these differences and then multiply them. So this is monthly return minus the estimated mean multiplied by the same for the second ETF. So this is computing the same product for every month. Now I will add up these sums. So I will sum them all up. And then I also divide it by t minus 1. So, or by 119 in our case. And so now this number here is the covariance, or the sample covariance between the total stock market in the US and the returns on the long bond ETF. You could see that this number is negative, which means that there is a negative covariance and hence will be a negative correlation between the returns on these two financial instruments. Now that we know the covariance, let us compute correlation. So correlation will be just the covariance, which we'll have to divide by the two standard deviations which we already computed. So we will take this number and we will divide it by the standard deviation of the first ETF and by the standard deviation of the second ETF. And now, so this is the correlation. So you could see that correlation is almost negative 50%. Now, of course, there has to be another way of computing this correlation, and we can simply just use the correl function in Excel, which does this job for us. So if we do this first array here, so it requires two inputs, so the first array and the second array. So this is the first one, and now this is the second. And when we hit enter, we're going to get exactly the same number. The point of this exercise is to show you that we can compute all of the statistics by hand because we understand what the statistics are, but then we can use built-in functions to compute these correlations more automatically. So this is the correlation between VTI and TLT. I will delete this column for now because we don't need it anymore, and I'll just use this function to compute these correlations. So this is the correlation between VTI and TLT. The other correlation here will compute the correlation between TLT and the emerging market ETF. So this one. And this is the second array. So this would be the correlation between TLT and VWO. And the third correlation here would be the correlation between VTI, so between the US stock market and the emerging stock market. So correl, and then I'm putting the first array in, and then the second array. And this is the result. So it paints us a very interesting picture. So first is that there is very negative and strong correlation, at least historical correlation, between the returns on the total stock market in the US and on the long bond. Second, there is also low correlation, although a little less, between the returns on the bond ETF and the emerging markets. And the third fact, and perhaps very interesting fact, because you would have thought that maybe returns on the US stock market and emerging markets are not very well correlated, what this number shows here is that the correlation between the two is almost 75%, which is a very significant correlation. Means that US stock market, at least historically again, and emerging stock markets correlated very highly with one another. If you are a US investor and you're looking to diversify your current portfolio, let's imagine that you're 100% invested in the US stock market, and you would like to diversify your portfolio, you might think that investing in the emerging stock market is a good idea because it provides large diversification benefits. And it does, because correlation is not exactly one. However, there is still a high degree of correlation between the US stock market and the emerging stock markets. Again, it was so at least historically. And if you really want to diversify, you're much better off investing in the long-term bonds or long-term ETFs, as indicated by these numbers here in this TLT ETF, because of this low negative correlation between the returns on the US stock market and on the US long-term bonds.
In this question, we will learn what is a portfolio and how to compute portfolio weights. Suppose that you're a financial advisor and you have the following two clients: client P with a portfolio P and client Q with a portfolio Q. Client P has the following securities in her portfolio. She invests $25,000 in SPY, which is ETF that tracks S&P 500 index, $35,000 into this ETF. This is ETF, Vanguard's ETF that tracks returns on short-term treasury securities, and $50,000 into this ETF. This is iShares ETF that tracks return of emerging markets. Now, client Q has the following portfolio. So $10,000 invested in SPY, so same ETF, $10,000 invested in this short-term treasury ETF, $30,000 is invested in this emerging markets ETF, and $20,000 invested into this additional ETF that tracks returns on mortgage-backed securities. So notice that client P does not have MBB or this ETF in her portfolio, but client Q does. So the first question that we'll answer here is that we'll compute portfolio weights that clients P and Q have on each individual securities in their portfolios. Let's start with client P. So first, to compute the weights of each of these individual ETFs in her portfolio, first step is to compute the total value of her portfolio. So this is just weighting up the total asset value of each individual ETF. This gives us $75,000. Then to compute the weight that SPY has in her portfolio, we're taking the value of SPY in her portfolio, so $25,000, and dividing it by the total value of the portfolio, which is $75,000. This gives us 1/3, or 0.33. We're doing exactly the same for the second ETF, for the short-term treasury ETF. So it is $35,000. This is assets under, or the value of this ETF in this portfolio, divided by the total value, $75,000. This gives us 0.47. And finally, for the emerging markets ETF, 15,000 divided by 75,000 gives us 0.2. Now, these are the weights. So this is the answer to this question. So the weight of SPY is 0.33. The weight of short-term ETF in this portfolio is 0.47. And the weight of IEMG is 0.2. Now, let's verify. So this is going to be trivial, but let's still verify that the weights in this portfolio add up to 1. Remember that this is a definition of the portfolio. So a portfolio is a collection of securities such that the weights of each individual security in the portfolio should add up to 1. If they don't, then this is not a portfolio by definition. So here, just to verify, so 0.33 plus 0.47 plus 0.02, this gives us exactly 1. Again, in this particular case, this is trivial, but this is just reemphasizes the definition of what portfolio actually is. Let's repeat the same process for client Q, or for portfolio Q. So the total value of this portfolio is the sum of the value of individual ETFs. So this is $70,000. To compute the weight of SPY, we're taking the value of SPY, 10,000, dividing it by 70,000. That's the total value of the portfolio. So that gives us 0.14. We're doing the same for short-term treasury ETF. So 10,000 divided by 70,000, also 0.14. The weights of the emerging market ETF is 30,000, its value, divided by 70,000, that's 0.43. And finally, the weight of the mortgage-backed securities ETF, 20,000 divided by 70,000, that's 0.29. So these are the weights of each of these 4 assets in the portfolio of this client Q. Again, just to check, to make sure that all of the weights add up to 1, we can add them all up, and just to verify that they all add up to 1, and this indeed is a portfolio, so that we haven't made a mistake computing any of the weights here. Now, let's assume that portfolios P and Q get combined. They get combined into a new portfolio, and we'll call this portfolio R. So for example, imagine that P and Q are trusts, and they just combine, they merge, and they combine their assets. And so all of these assets get combined into portfolio R. And now the question is, what are the new weights of these individual assets in this new portfolio, in the merged portfolio R? Find the weights of individual assets in this new portfolio R. First, let's find the total value of portfolio R. So we're simply adding up the value of each of the individual assets, or because we knew the value of portfolio P and the value of portfolio Q, so 75,000 and 70,000 respectively. So the total value of this combined portfolio right now is 75,000 plus 70,000. That's $145,000. So that's the total value of portfolio R. To find the weights, we're simply adding up the weights of individual positions in portfolios P and Q and dividing it by the total value of the new portfolio. So 25,000 for SPY in portfolio P plus 10,000 for SPY in portfolio Q. So that's 35,000 divided by 145. And that's 0.24. Same exact process for the remaining three assets. So for the short-term treasury ETF, $35,000 here plus 10 here divided by 145. That's 0.31. For emerging markets ETF, 15,000 here, 30,000 here divided by 145, also 0.31. And for the mortgage-backed securities ETF, 0 here, 20,000 here divided by 145,000, that gives us 0.14. And so these are the weights of each of the four individual securities in this new portfolio, combined portfolio R. Again, just to make sure that we haven't done arithmetic mistakes somewhere, to make sure that that didn't happen, we add up the weights of individual assets and just make sure that it all adds up to 1. And in this case, it indeed all adds up to 1. So this portfolio looks okay. So all of the weights add up to 1. And this is how you compute portfolio weights given the position on individual assets in the portfolio. Suppose that you have $20,000 that you would like to invest. You're very bullish on the future of clean energy, and you found the following exchange-traded fund or ETF that you would like to invest. iShares Clean Energy ETF, the ticker symbol ICLN. But you are so bullish on the clean energy that not only you want to invest all your wealth into this ETF, you would want to borrow and invest borrowed money into this ETF as well. Your broker allows you to borrow up to $45,000, giving you a wealth of $20,000. So what you will do is that you will borrow the full amount of $45,000 and you will invest all of it into this ETF. The first question asks us, what is the weight on this ETF, on ICLN, in your portfolio? By definition, the weight in your portfolio on ICLN would be your position in this ETF, which is $20,000, this is your initial wealth, plus your borrowed funds, divided by your total wealth, often referred to as the equity of your portfolio. So your position divided by your wealth by $20,000. So this gives us 325%. So the weight on this ETF in your portfolio is 325%. We can also compute the weight that you have on the loan or on borrowed funds in your portfolio. So you borrowed $45,000, hence it goes a negative sign, divided by your wealth. So this gives us negative 225%. Now, this indeed is a portfolio because if we add up your weight in these borrowed funds plus your weight in this ETF, this gives us 100%. And so recall that by definition, a portfolio or weights in the portfolio have to add up to 100%. The second question asks us, what is the leverage ratio of your portfolio? Let's start again with the definition of leverage ratio. So leverage ratio is the total asset value that we have in our portfolio divided by net investment. So the total asset value is $65,000. This is how much we have invested in this ETF. And our net investment is $20,000. So this net investment is your own wealth, or also we refer to it as equity of your portfolio. So, and this ratio gives us 3.25%. So the leverage ratio of this portfolio that we constructed here is 3.25. Now, suppose that you were right and the value of this ETF, so the value of clean energy ETF, increases by 25%. The question is, what is the return on your investment? Let's answer this question. First, I will compute the total asset value of your portfolio. So recall that we have $65,000 invested into this ETF. So this asset value right now increased by 25%. So the new value is $81,250. Now, of this, $45,000 is borrowed. So therefore, your net investment, the new value of your net investment, is the new asset value minus this borrowed amount. This gives us $36,250. So therefore, you have invested $20,000, and right now your net investment is $36,250. So now we can compute the return. So the return is the new value of your net investment minus the original value divided by the original value. And so this gives us 81.25% return. So therefore, if the energy ETF increased in value by 25%, the value or the return on your investment is 81.25%. Now, let me show you an alternative way of doing the same calculation. Recall that the leveraged investment return equals to the leverage ratio times the asset return. So this is the overall change in the value of your portfolio. And so in this case, our leverage ratio that we computed before was 3.25. And now we are multiplying by how much the asset value or our ETF has changed. This is 25%. And so this gives us 81.25% return. And this exactly matches the number that we've computed up here. So this is one of the major benefits of knowing the leverage ratio of your portfolio, because it allows you to quickly understand and approximate and measure by how much the value of your original investment has changed as a function of how much the total value of assets changed in your portfolio. So in this case, the value of assets increased by 25%. And because we have a leveraged position and this is our leverage, we have the net investment gain of 81.25%. Now assume, on the contrary, that instead of increasing in value by 25%, the value of this clean energy ETF declined by 25%. So in this case, what is the return on your portfolio? Let's do exactly the same two calculations to answer this question. So first, let's compute the new asset value. So this is our original value, now declined by 25%. So the new value is $48,750. The net investment then, so this is the new asset value minus your borrowed amount. So the net investment is $3,750. And now we can compute the return. So the return is your net investment minus your original net investment, so your initial wealth, divided by your, again, initial net investment of $20,000. This is negative 81.25%. So if the value of this ETF declines by 25%, your returns on your portfolio is, on your initial investment, is negative 81.25%. So now the final calculation here is that it computes exactly the same return on your investment as a function of the leverage ratio of your portfolio. So again, leverage investment return equals to leverage ratio times the return on the assets in your portfolio. So in our case, this is 3.25% multiplied by negative 25%. So this is the decline in the value of our asset. So this gives us negative 81.25%. Again, the same number as we computed here manually. So let's summarize this question. If we just invested our initial wealth into this clean energy ETF, the returns on our investment would have been either negative 25% if the value declined by 25%, or positive 25% if the value increased by 25%. So this is the situation when we had no leverage. With leverage, if we borrowed $45,000 and invested the entire $65,000 into this ETF, then if the value of ETF either increased by 25% or decreased by 25%, our net investment returns would have been either negative 85.25% or positive 81.25%. So this leverage magnifies both gains and losses for our initial investment. And that's the idea behind leverage. In this question, we're given two stocks, stock A and stock B, with the following properties. Stock A has expected return of 20%, stock B has expected a return of 15%. Standard deviations are 20 and 25% respectively. The correlation between the returns on stock A and stock B is 0.2 or 20%. The first question asks us whether any investor would ever invest in stock B. And this is a reasonable question to ask because if you look at the properties of stock B and compare them to stock A, stock B looks indeed on its own inferior to stock A. So it has lower expected return and it has a higher standard deviation. So hence the question, would ever any of the investor here would ever invest into stock B? And the answer is yes, because of its low correlation with stock A, this stock, although on its own inferior, may provide diversification benefits. And hence, a rational investor may want to invest a fraction of his or her own wealth into stock B to get these diversification benefits. In the next question, we are asked to form the following portfolio. So we will mix or we'll invest 60% of our wealth into stock A and 40% into stock B. So we're going to form this portfolio, which I will refer to as P, which again invests 60% in A and 40% in B. The question asks us to find the expected return on this portfolio P. Let's use the definition of expected return for a portfolio. Expected return on a portfolio would equal to the weight that we invest in the first stock times the expected return on this stock, plus weight that we invest in the second stock times the expected return on the second stock. Now, if we had more, you could see that this is just a simple linear function. So if we had more stocks in our portfolio, we could just continue writing the following linear expression. So now, since we have only two stocks, we can plug in the weights and the corresponding expected return. So weight in A is 60%, expected return 20, 40% in B, and its expected return is 15%. So if we compute this, this will give us 18%. So the expected return on this portfolio P is 18%. The next question asks us to find the standard deviation of this portfolio P. So recall that this portfolio P puts 60% into A and 40% into B. So let's write down the expression for the variance of a portfolio of two stocks. So the variance of this portfolio RP equals to the weight that we put in the first stock, stock A, squared, times variance of the returns on stock A, plus weight that we put into stock B, squared, times variance of stock B, plus 2 times weights that we put into A and B, times the covariance of the returns between stocks A and B. In this question, we're given the correlation of returns between A and B. So what I will do is that I will expand this equation where I will express covariance as the function of standard deviations of returns on stocks A and B and their correlation. So the first two terms remain the same. The third term becomes 2 times the weights times the standard deviation of the returns on A times the standard deviation of the returns on B times the correlation of returns between the two stocks. So this is just the definition of the covariance. Now we're ready to plug in all the numbers. So the weights are 60 and 40%, so it's 0.6 squared, 0.4 squared multiplied by the variance of the returns on stock A, which is standard deviation is 0.2 or 20%. Then it means that the variance is this 20% or 0.2 squared. 0.25 for stock B, so 0.25 squared, this is the variance of stock B. And this third term is the covariance or the correlation term. So it's 2 times the weights times 2 standard deviations, so 0.2 and 0.25, times the correlation of the returns between stocks A and B. So this is 0.2. So when we compute this, we get 0.0292. And so this is the variance of the portfolio P. Since the question asks us to find the standard deviation, so what we do is that we're taking the square root of this variance, and we get 17.1%. So this is the standard deviation of the returns of the portfolio P, which invests 60% into stock A and 40% into stock B. Now, suppose that the correlation between returns on stock A and stock B increases from 0.2 to 0.6. We're going to keep the same portfolio P that invests 60 into A and 40 into B, and we will try to compute the expected return on this portfolio and the standard deviation. So first, let's answer the following question. Does the fact that correlation changed from 0.2 to 0.6 affect the returns on this portfolio? The answer is that it doesn't. The expected return on the portfolio only depends on the weights that we put in the corresponding stocks and on the expected returns on the stocks. It does not depend on how returns on different assets covary within that portfolio. So, therefore, expected return in this case stays the same as it was before. In particular, it is 18%. Now, standard deviation, on the other hand, for the portfolio P is affected, because if we look at the formula for the variance of portfolio P, we see that it obviously depends on the correlation of returns between A and B. And so now, to compute the standard deviation, what I will do is that everything else stays the same. So the only term that changes in this equation is the correlation term. So instead of 0.2, what it was before, it is 0.6 right now. And so I highlighted it in pink color. And so if I compute the variance of this portfolio P right now, given this new correlation, it gives me 0.0388. And so to compute the standard deviation, I again have to take the square root of this term. And so this gives me 19.7%. So when correlation goes up to 0.6, expected return stays the same at 18%, but the standard deviation of the portfolio increases from 17.1% to 19.7%. In this next question, we are asked to construct a portfolio with expected return of 19.5%. I will call this portfolio Q. So we want to construct a portfolio such that expected return is 19.5%. So let's again start with just the definition or the expression for the expected return of the portfolio. So the expected return of the portfolio Q equals to the weight that we put into A times the expected return on stock A plus weight that we put into B times expected return on stock B. Now, notice that by definition of a portfolio, weight A plus weight B has to add up to 1. So here I will write an expression for weight B as the function of weight A, and I will plug this into the above equation. So this is going to give me expected return for portfolio Q as the function of weight that we put into A times expected return on stock A, plus 1 minus weight that we put into A times expected return on stock B. And now we want to make this expression equal to 19.5%. So now I'm going to plug in expected returns for stocks A and B from what's given, so 20% and 15%. And this becomes just an equation with one unknown. So we can solve it for WA, and this gives us 90%. So therefore, to construct a portfolio that gives us expected return of 19.5%, we put 90% of our assets into stock A, and the remaining 10%, because again, weights have to add up to 1, and we have only 2 stocks, so the remaining 10% we put into stock B. So portfolio Q would be 90A and 10B. Now, what is the standard deviation of this portfolio Q that puts 90% into A and 10% into B? Let's use again just the formula for the variance first, and then we'll compute standard deviation based on the variance that we computed for this portfolio Q. So again, it's weight squared times the variance of A plus B, weight that we put in B squared times the variance of the returns on stock B, plus 2 times weights times standard deviation of A, standard deviation of B, times the correlation. So notice that I go back to correlation, the original correlation coefficient that we had between the two stocks, which is 0.2. So I plug in all of the numbers. So 0.9 squared, this is our weight, 90% that we put in this portfolio Q into stock A, so 90% squared, times 20% squared, plus 0.1 squared, plus 0.25 squared, plus 2 times 2 weights, so 0.9, 0.1, times the standard deviation, so 0.2, 0.25, times the correlation, so 0.2. So this gives me 0.035, and this is the variance of our portfolio Q. Taking square root of that gives me the standard deviation of this portfolio Q, which is 18.8%. So what we've done in this question, we're able to construct a portfolio with a given expected return that we want, which is 19.5%, by putting 90% into stock A and 10% of our wealth into stock B. And this particular portfolio Q has the standard deviation of 18.8%. In this question, we will look at diversification benefits of holding a portfolio with many stocks. Let's assume that the average stock has a volatility of 35%. So that's the standard deviation. Let's also assume that the average correlation between pairs of stocks is 25%. And let's compute the following. Let's compute the volatility of equally weighted portfolio that has just 1 stock, 20 stocks, and 500 stocks. Let's first derive the variance of portfolio P, equally weighted portfolio. So this is the sum of all possible combinations of covariance between stock I and J with the weights that we put into stock I and J. So if we think of this variance-covariance matrix where we have on the diagonal the variance of individual stocks and of diagonal elements are the pairwise covariances, then this is just simply the weighted average of all of these items in this matrix, again, with the weights of that we put in each of these individual stocks, these W's. Since we have an equally weighted portfolio, these W's are, each of them are just 1 over n, and so this product is just 1 over n squared. So this variance becomes the sum of 1 over n squared multiplied by the pairwise covariance between stock I and stock J. Now I'm going to break down this sum into the following 2 sums. One is the sum of these variances. So visually, if you think of this term, what I'll try to do visually here is that I will separate the variance, what I have here on the main diagonal, from the covariances. So I'm taking the variance, and there are n of them, and so 1 over n squared times all of the sum of these variances, plus 1 over n squared, the remaining sum of all possible covariances here. So notice that in this covariance term, I'm saying that this is the first summation from I to n, and then the second summation from j to n, but I'm saying that j should not equal to I because these are the ones that, these would be the variance terms that I separated into this first sum. So now, what I'm going to do further is that I will factor out 1 over n first, and then what's going to be remaining here is 1 over n times the sum of the variances here of all stocks from 1 to n. And so this term right here in parentheses is just the average variance. We can think of it this way. And we know, because this question gives us what is the average volatility of stocks, so we would know what is the average variance. So similarly, here I will try to isolate the average covariance in the second term. So the average covariance is just the sum of all of the covariance divided by the number of the covariance terms that we have. What is the number of these covariance terms here? Well, again, so referring back to this matrix, you can think of it as just the number of diagonal elements here. And so if the total number of elements in this matrix is just n squared, the number of diagonal elements is n squared minus n. And so therefore, I'm isolating here 1 divided by n squared minus n. So this is the number, again, of the covariance terms, multiplied by the sum of all of these covariance terms. And that's what's remaining. So it's n squared that we had before. And I'm multiplying here by n squared minus n to offset this additional division that I put here so that this represents the average covariance. Now, so what we have is that the variance of this portfolio, equally weighted portfolio, equals to 1 over n multiplied by the average variance, plus this term, which is, you can see that n squared is going to cancel out. So it's 1 minus 1 over n, so this term. And then what I have in parentheses here is just the average covariance. And so therefore, we have 1 over n times average variance plus 1 minus 1 over n times the average covariance. And again, we know both the average volatility here, the average variance, and the average correlation, so we can compute the average covariance between the pairs of stocks here. Now, once we know this expression, now we can plug in n equals to 1, n equals to 20, and n equals to 500, and to compute the variance of these portfolios. So let's work with this expression to compute the volatility of equally weighted portfolios of 1, 20, and 500 stocks. So first, let me compute the average variance and average covariance from the information that we're given here. So the average variance would be just the average standard deviation that we're given, 35% squared. And the average covariance would be the average correlation, which we're given again, 25%, multiplied by 2 standard deviations of the average standard deviations of stocks. So 0.35 times 0.35. And now, so we know the average variance and we know the average covariance, so we can compute, we just simply can plug in n's for 1, 20, and 500, and compute the variances and standard deviations of these respective portfolios. When n equals to 1, this is the variance, and the standard deviation of this portfolio would be 35%. And it does make sense. So if you look back at this equation, so if n equals to 1, this term equals to 0, so this is not relevant, and so this equals to 1, and so this is just the average variance. And so therefore, if we have just portfolio of one stock, its standard deviation is going to be equal to the average standard deviation of stock here, 35%. When we have 20 stocks, this is the variance that we can compute by plugging 20 in here, and the standard deviation of this portfolio would be 18.77%. When we have 500 stocks, the standard deviation of this portfolio would be 17.55%. So these are the volatilities of these 3 portfolios. Now, let's look at these numbers. By combining as few as 20 stocks into a portfolio, equally weighted portfolio, we were able to reduce the volatility almost twice, from 35% to 18.77%. So this is a dramatic reduction in volatility, and we get it by just combining as few as 20 stocks in our portfolio. Once we keep adding more stocks, we still get diversification benefits, but they're not seemingly as large as they're here in the very beginning when we're combining just few stocks. You can look at this from when we get from 20 to 500, the reduction in volatility is just from 18.77 to 17.55%. So this is, again, so there is a reduction here, but seemingly not as large as it is here originally. And so therefore, the main lesson here is that we get a lot of diversification benefits by combining just a few stocks in our portfolio, given that the average correlation between the returns is not that large. And so in this particular case, if it's 25%, most of this reduction is driven by the fact that we're combining few stocks, and the average correlation between these stocks is just 25%. And so as we keep adding, we don't get as much as we get this initially when we're adding few stocks. Let's see what happens when we're combining more and more stocks in our portfolio. In other words, when n goes to infinity. When n goes to infinity, the variance of this portfolio is going to become equal to average covariance. We could see it from this expression. 1 over n is going to go to 0 when n goes to infinity. 1 minus 1 over n is going to go to 1. And so therefore, this expression is just going to become average covariance. And therefore, the standard deviation of the portfolio that has infinitely many stocks would be the square root of the average covariance, which would be 17.5%. So as we're combining infinitely many stocks, the absolute minimum that volatility of our portfolio that we can achieve in this particular economy is 17.5%.